Fear came back into the market in a very big way.
What we know now is Wall Street can bring down Main Street.
People are seeing this, and those memories of fear are coming back.
When you have a 401k or a 403b, those kinds of accounts, they are incredibly susceptible to downturns.
The Dow Jones Industrial Average dropped more than 900 points. More than 900 points.
There are questions about how to best save for retirement.
Part of the problem is confusion.
Time keeps on slipping into the future.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
When the market goes up, you go up. When the market goes down, you don't go down. Save Money Radio, your money safe and sound.
Welcome to Safe Money Radio with your host, Brad Pistole. Brad is a retirement and income specialist, primarily serving Springfield, but he's sought after nationally for his expertise in helping people secure their retirements. Mr. Pistole is a licensed life insurance professional in the states of Missouri, Arkansas, and Kansas, and he specializes in working with people who are near retirement and those who have already retired with wealth management, income planning, and asset protection strategies.
Save Money Radio, your money safe and sound.
And now, here to talk with you about securing your retirement, your host, Brad Pistole.
Welcome to Safe Money Radio and the Safe Money Radio podcast. Now, if you didn't know that there was a podcast, just go to YouTube, Spotify, or Apple Podcasts and type in Brad Pistole and Safe Money Radio. Then you'll be able to listen to us anytime you want to. Now, today, we're going to be talking about one of the hottest topics on the planet when it comes to retirement income planning, and that's Social Security. If you've listened to the show for any amount of time, you know we stress the importance of when and how you file for your Social Security benefits on a regular basis on this show. And several times over the past few years, we've had my good friend and national Social Security expert Heather Schreiber on the show to talk about this. In fact, one of my YouTube videos with Heather, which is titled The Social Security Break-Even Point, has been viewed by more than 20,000 people. And if you'll stay with us today, we're going to play part of a previous segment with her at the end of the show. Here's the thing. The timing of Social Security is critically important to the success of your retirement income plan. And most retirees, including a majority of financial experts, don't even realize how important this is. You see, most financial professionals hang their hats on the rate of return that they can get you inside your retirement accounts. But if it comes to tax planning, most financial professionals pass the buck to your CPA. And what many people don't realize is how you trigger your Social Security benefits and when you trigger your Social Security benefits will have a major impact on your overall tax planning in retirement. If you don't believe me, then you'll probably do what far too many people do. If you fail to work with a retirement income certified professional and you don't do the proper research, you'll find out the hard way. And what's the hard way? Well, that's when you've already triggered your Social Security benefits and you find out after your first year of filing taxes just how big of a mistake you've made. And guess who wins when you do things the hard way? Uncle Sam. You see, you won't realize how big of a mistake you've made until after your taxes are due in April of the year after you've already started taking your distributions. And in many cases, this will have already triggered an up to 85% tax on your Social Security benefit, and it can also trigger the dreaded IRMAA tax that we talk about on this show regularly, and we're going to talk about more of it today. What is the IRMAA tax? Well, this stands for Income-Related Monthly Adjustment Amounts. And this surtax can be as high as $594 a month for your Part B Medicare premium. If you make an uninformed decision when it comes to when and how to file for your Social Security benefits, and it increases your monthly Medicare premiums from $174 a month to $594 a month, would it impact your retirement budget? What if it also triggered an 85% tax on your Social Security benefit because you didn't realize that other taxable forms of income, like distributions from an IRA or a 401k, dramatically impact the taxes that you pay on your benefits once you've filed? Would you be a happy camper at that point? And don't forget, once you've made the decision to trigger your Social Security benefit, this decision is irreversible after 12 months. So you better make sure you're working with someone who knows what they're doing when it comes to retirement income planning. Now, friends, if this is the first time that you've ever listened to the show, make sure you go to YouTube or Apple or Spotify and subscribe to the podcast. You can also go to YouTube and type in Brad Pistole and Social Security benefits, and it will pull up dozens of videos that we've shared to help you navigate these critically important decisions for retirement. And remember, you can always call us at any time to request a free financial consultation. Our number is 866-780-SAFE. That's 866-780-7233. If you call in and request to meet with us, we'll take a look at your overall financial situation and come up with the best plan to make sure you will never run out of money in retirement. And we will show you how to avoid the number one pitfall for retirees, which is paying too much to Uncle Sam in taxes. Remember, once you pay a tax that you didn't have to pay, that money is gone forever. You will never get it back. We want you to stop paying unnecessary taxes, and this can include IRMAA taxes and taxes on your Social Security benefits. So stay with us for the rest of the show. We're going to be focusing on Social Security and ways to maximize your benefits today. Call us anytime at 866-780-7233. We're here to help you secure the retirement of your dreams. Friends, today we're talking about Social Security and what a huge piece of the retirement puzzle it represents. So buckle up and let's jump right in, because there are so many misconceptions and so much misinformation about how the system works. So let's start off with some basic facts. Have you ever thought about who pays for Social Security? You see, we all do. Workers and employers each pay 6.2% of gross wages to fund Social Security benefits. And if you happen to be self-employed like myself, you get the privilege of paying both shares as employer and employee for a combination of 12.4%. We pay these FICA taxes up to a certain taxable wage base. For 2024, it's about $168,600. Now, if you make more than that, you don't pay FICA taxes on that excess amount that funds Social Security. You see, Social Security is a pay-as-you-go system. The taxes you pay now as a worker are funding the benefits for everyone who is currently retired and receiving their benefits. It's a pooled benefit, and today's workers pay taxes that pay the benefits of the people who are already retired. In other words, when you finally get around to claiming your Social Security benefits, you will be relying on the taxes paid in by the workers at that time who will be funding your benefits. And this may or may not make you feel very comfortable when you consider the work ethic of today's generation. You see, if they don't work, the money won't be there. It's just that simple. So you better be nice to your kids. And in addition to all the taxes that you pay into the system, in order to qualify for benefits, you have to earn a minimum amount of credits to receive your benefits. And this is really important. You can earn at least 4 credits per year, and you need a minimum of 40 credits. So basically, you have to work in a covered job for at least 10 years to be eligible for a future Social Security benefit. If you don't have 40 credits, you can't get a Social Security benefit. But the good news is, every time you continue to work, regardless of your age, it will continue adding to your earnings history. So once you get to those minimum 40 credits, you'll be ready to receive your benefits. One of the most common questions concerning Social Security is, well, how are my benefits calculated? Now, friends, I've heard all kinds of coffee shop talk about this, but 99% of the time, the answers are completely wrong. So don't listen to anyone at the coffee shop. This is how it works. Your benefit is based on your average lifetime earnings. Social Security defines this as your top 35 years of earnings indexed for inflation. You get your top 35 years of earnings to indicate what your average lifetime earnings were, and then they apply that to a formula. Now, what happens if you didn't work for 35 years? Maybe you were a stay-at-home mom and you only worked for 20 years and you took care of your kids. you will have 15 years of zeros in your calculations because Social Security always divides by 35. So let's take me for an example. I was in full-time ministry from age 19 to age 36. And as a 19-year-old youth and family pastor, I opted out of paying into Social Security. That means I have 17 years of zeros in my own personal Social Security calculation. So even if I delayed my own Social Security income to the maximum age of 70, I will still have 2 zeros in my calculation. This 35-year period is critical to receiving your maximum benefits. So you definitely need to think about this 35-year period if you've had a time in your life when you didn't work and you didn't pay into the system. It will definitely affect your future lifetime distributions because of those zeros. Now, with that being said, the biggest factor outside of this 35-year period of earnings that will determine how big your benefits are involves your age when you choose to claim benefits. As many of you know, you can claim benefits as early as age 62, and in some cases, that may make sense. But if you do, your benefits will be permanently reduced by 25% or more, depending on your birth year. So here's an example of how this works. Let's take someone who was born in 1954. You see, that was the last year for someone to have a full retirement age of 66. For those born 1 year later in 1955, it's not age 66, it's age 66 and 2 months. And the full retirement age after that continues to increase 2 months for each year until 1959. For everyone born in 1960 or later, the full retirement age is now 67 until Congress changes it. There are other disadvantages for claiming your benefits early, and here's one of them. If you continue to work and earn taxable income, not only will your benefits be permanently reduced based on the age that you claimed, but you will lose even more benefits if you earn too much money. Now, in 2024, the earnings limit is $22,320. Social Security will hold back $1 of every $2 you earn above this amount. So this is another great reason to delay your benefits until you reach your full retirement age. If you wait until your full retirement age, not only do you get 100% of the benefits that you've worked so hard for and paid so much for, but there is no earnings restriction. So you can earn as much money as you want and still receive 100% of your Social Security paycheck. You can earn a delayed retirement credit that's worth 8% for every year that you postpone claiming your Social Security benefit beyond your full retirement age. And you can do this all the way up to a maximum age of age 70. So in other words, if your full retirement age is age 67, you would have a benefit that would be 24% higher if you waited until age 70 to start your benefit. Now, I meet far too many people who have the philosophy regarding Social Security that goes something like this. Well, Brad, I can tell you right now, no matter what you say, I'm claiming the day I turn 62. Okay, well, let me ask you, based on what math and science? Because here's what they will normally say. Well, Social Security is going broke. It might not even be here by the time I reach age 70, so I'm going to take it as soon as I can take it. Okay, I get that, but just make sure you're making an educated decision. The difference between claiming your benefits as soon as possible at age 62 and waiting to the maximum age of age 70 means your monthly Social Security paycheck would increase by 76%. Now, friends, that's not a typo, and I didn't misspeak. That's a 76% increase by waiting from age 62 to age 70 to claim your Social Security benefit. And as a retirement income certified professional, I can tell you this. There are only 2 things that I'm aware of that are guaranteed to increase 76% over an 8-year period. It's Social Security benefits when you choose to delay, and certain types of annuities with 8% guaranteed lifetime income benefit riders attached to them that will contractually increase your benefits 8% for every year that you defer your income. That's it. They're the only 2. With anything else, you're taking a chance. And when it comes to deferring your Social Security benefit from age 62 to age 70, not only does that increase by 8% per year between your full retirement age and age 70, but every single cost of living adjustment, known as the COLA, is applied between the time you're 62 and the time you claim your benefit. That's also added in. So your benefit could be significantly larger. Does this have your attention? I hope so, so keep listening. Well, I must take a short break. This is Brad Pistole, and you're listening to Safe Money Radio. Let's pause for some exciting announcements.
Are you age 59 and a half or older and still working? Did you know that you may be able to move some or all of your retirement money to an individual retirement account without any taxes? Why keep your money in your employer's plan with management fees, exposure to significant market risk, and limited options for guaranteed lifetime income that you can't outlive? What will happen to your plan at work if the market crashes? Call Brad Pistole now for retirement planning that will protect what you've worked so hard for and create a retirement that is safe and secure. Call 866-780-SAFE. That's 866-780-7233. You're listening to Safe Money Radio with your host, Brad Pistole.
Thank you for tuning in to Safe Money Radio. I am Brad Pistole, a market risk mitigation specialist helping clients with retirement money preservation and income planning. Now, before the break, we were talking about Social Security benefits and the different reasons you might consider delaying your benefit past the age of 62, which is the first time that you're able to start receiving a Social Security paycheck. Now, one of the reasons is because of the earnings limitation. For a quick review, if you missed the first part of the show, here's the way this works. If you start your benefit at any time between age 62 and your full retirement age, and you continue working and earning taxable income, not only will your benefits be permanently reduced based on the age that you claimed, but you will lose even more benefits if you earn too much money. In 2024, the earnings limit is $22,320. Social Security will hold back $1 for every $2 you earn at about that time. But here's another big reason. Remember, after the death of the first spouse, you lose the lower Social Security benefit. Here's an example. My own father's Social Security benefit was $2,972, and my mother's benefit was almost $1,000 a month. When my father died in 2022, my mother lost her $1,000 a month benefit, and she started receiving my father's benefit. Now, friends, let's do some quick math. That's a $12,000 loss of annual income to my mother. Here's a question for you. Do you have a plan for this in your retirement income future? What if both of your benefits are close to the same amount? What if you and your spouse worked your entire careers and your benefits are both roughly, let's say, $2,500 a month? Do you know what's going to happen after the death of the first spouse? There will be a $2,500 monthly loss in income for the rest of the life of the remaining spouse. In other words, your permanent loss in annual income will be $30,000 a year for the rest of your life. Would this create a major income problem for you? Do you understand now why things like permanent life insurance are so important? You see, my good friend Ed Slott, a CPA, says life insurance doesn't cost, it pays. And it pays tax-free to your family members when they need it the most. Let's say you owned a $300,000 permanent life insurance policy on each other. No matter what, upon the death of the first spouse, the surviving spouse will receive that $300,000 benefit. And remember, they're going to have just lost a Social Security check. So from the examples that I shared earlier, this could mean a $12,000 loss like it was to my mother, or it could mean a $30,000 a year loss in income. Now, if you owned that $300,000 life insurance policy, you would have just provided between 10 years and 25 years of tax-free income for your spouse who's going to continue living after you're gone. Remember, they're going to lose a Social Security check. Do you think this is important information? If you don't, you need to think again. So here's another powerful reason for delaying your Social Security benefit beyond the age of 62. Spousal income planning. Remember, upon the death of the first spouse, you lose the benefit of the lower income earner. That means the larger Social Security benefit is the lifetime benefit for your family. It is a pension that's going to last for the rest of your life. What if both spouses trigger their benefit at age 62, as soon as you can? That means you both just permanently reduced the future paycheck of the surviving spouse by 76% because you both chose to start early. That's why the majority of my colleagues who are retirement planning experts will say the larger earning spouse should consider delaying their Social Security benefit as long as possible. They should wait at least until their full retirement age or even to the maximum age of 70, if it's possible. Now, why is that? For the double benefits of maximum higher income while they are living because they delayed their benefit and because they've increased the check that's going to pass on to their spouse after the death of the first spouse. Have you ever thought about this? Well, if not, you probably know the famous saying, failing to plan is planning to fail. This is exactly why we talk to all of our clients and listeners about this. We are retirement income certified professionals, and we are focused on the second half of the game. So many people fail to realize that you don't reach the finish line when you retire. In many cases, you're barely at the halfway point. Many people will be retired for 30 to 40 years. Does your current plan allow for all of the changes and hurdles that you're going to face in the next 30 years? If not, why not? This is too important to leave up to a game of chance or for guesswork. You need guarantees in your retirement income plan. I once heard a financial professional say, Social Security is complicated. There are more than 2,700 rules that govern your benefits. Don't underestimate the value of guaranteed income that is inflation adjusted for the rest of your life, no matter how long you live. Certainly, you should take your health and other sources of income and your marital status all into consideration when you decide when and how to claim your Social Security benefits. But for those who can afford to wait, there is a big, big reward at the end. The decision of when to retire and when to claim Social Security benefits are two separate things. Don't make the mistake of thinking they have to happen at the same time. Make sure you make each decision for the right reasons. Friends, if you missed the first part of today's show, we've been talking about Social Security and how it affects your overall retirement income plan. And I want to spend the rest of today's show replaying part of an interview that I did with national Social Security expert Heather Schreiber back in 2023, because we talked a lot about today's topic during that show. So sit back and listen to the nation's premier expert on Social Security planning, and let's listen to what she has to say. Heather, thank you again so much for joining us today. And we're going to jump right in. And this situation literally happened 2 weeks ago. Hunter and I were in a meeting with someone, and we keep hearing this over and over. And I thought, we've got to ask this to Heather and have her talk to our listeners about this, because even though I wrote this a couple of weeks ago, we came across it again just yesterday. So I know this is happening a lot. We had a client come in, and their mother had passed away, and they had received a lot of assets and income that they, of course, couldn't avoid. They had to sell some things. And when she came in, the first thing she said was, "Oh my goodness, my IRMAA is killing me." So what in the world is IRMAA? What does it involve? How does it affect retirees? Talk to us a little bit about what that is.
Yeah, so Aunt Irma is the aunt that we never want to visit us, but
That's
sometimes
right.
does if we're not aware. And Aunt Irma shows up 2 years later is the problem. So IRMAA, or also known as the income related monthly adjustment amount, is a surcharge that some folks who experience either higher income throughout retirement, or they have a one-time windfall, like it sounds like the one that you're talking about where they inherited something.
Right.
It is related to how much someone will pay for their Medicare Part B premium and Medicare Part D. And it's related to what's called MAGI, modified adjusted gross income, and Social Security when they're determining Medicare premiums for the current year. So for example, 2023 premiums. And for most people this year, it actually went down, right? It went to 164.90. Last year it was 170.10. So we actually got a reprieve. But for most folks, that's what they'll pay. But if their income, and Social Security looks at the income 2 years prior, they're looking at that modified adjusted gross income, which is adjusted gross income plus tax exempt interest. If that income goes above a certain threshold, so for 2023, if 2021's MAGI for someone who's single was above $97,000, or for married folks that are filing jointly is above 194,000, then you start getting into this, what I call IRMAA territory. And so oftentimes you don't think about it. You think, well, I inherited this, but what's happening? I never heard anything about it until I got my letter for 2023 saying I'm going to pay an income related monthly adjustment amount in addition to, so it's a surcharge in addition to the standard premium that most people pay, right? So that's the rub. And so what I always say is, I have a presentation that I do that's the critical ages of retirement income planning. And I always include age 63 in there. And everyone's like, 63, that's kind of a weird, we've got the age 50 for catch-ups, and we've got, 59 and a half is a magic age because the 10% penalty doesn't apply. Why 63? And I say, well, for folks that are going to enroll in Medicare, most people at 65 do. Now, there's some circumstances where they may not, right? They still have creditable coverage through a health, an employer-based plan or their spouse's plan, certain situations where they won't. But at 63, that's when they're going to start looking at your income. So go back to your person that said, wait a minute, I inherited this. Well, the likelihood is this inheritance probably occurred 2 years ago, and it's just now catching up with them. Now, what happens with, let's take the 65-year-old that has now retired, but at 63, they were still working, and they're saying, wait a minute, that's not fair. I was still gainfully employed. So of course my income was above that limit. Why am I being charged an IRMAA 2 years later when I'm truly, now I'm retired? So there are certain things called life-changing events that will, that the Social Security Administration do consider ways to say, hey, wait a minute, no fair, get Aunt Irma out of my life because 2 years ago I was still working, now I'm not. What are those? So it's not things, unfortunately, like an inheritance. It's things like marriage, divorce or annulment, loss of a spouse, death of a spouse, cessation, work stoppage, or pullback on work hours. Loss of income producing property. Now that isn't things like I sold a house and I lost the house, but now I got this big fat capital gain. That doesn't qualify. So there are certain things that are considered life-changing events so that if someone says, wait a minute, I'm being notified that I'm going to pay this extra premium, this surcharge. How do I get out of it? Well, there is a form, SS Form 44, life-changing event form that the person can say, wait a minute, let's use a more current year of income to substantiate why I shouldn't have to pay it. So IRMAA is something that for folks that have planned well, that might have sources of income that might be consistent and put them over it. Those are the folks that need to worry, or the people that have just a 1 year. Now, here's the good news about Aunt Irma as well, is that if this is just a one-time event, so an inheritance and that somehow that there's a taxable event, let's say it was an IRA inheritance, for example, and it did bump up the MAGI above the limit, then that's only a rub for a 12-month period, right? Because once they go back and they look again at the next year's MAGI, then if it's within the thresholds of the standard premiums, it goes back down. But the other side of that is, let's suppose you have two people on Medicare. Does it affect both of them? And the answer is yes. For that 12-month period, it's going to affect both of them. So you have to think about, you have to start forward planning when you're working with your financial advisor to say, okay, let's make sure that we are cognizant of the fact that what I do now is going to affect me 2 years from now if I'm well above it. So we have to think about those things.
That's super good, because in the situation we were talking about yesterday, and Heather, you'll certainly understand this. I'm sure minds of a lot of people are spinning right now trying to think back to 2 years ago and how that affects the future. But this person received inheritance because a spouse died. There was a business account, and their financial advisor and their CPA didn't explain anything about what would happen if she took a distribution from an S-Corp account, which was tax deferred. She took $100,000 out in December and $100,000 out in January. So guess what? That's 2 separate tax years. Right. So that messed with Aunt Irma. I'm stealing that, by the way. That messed with Aunt Irma for the next 2 years. And she, just so that people can understand the impact, and I'll have you speak to the specifics of it, but she said her IRMAA or her Medicare premium went up from like $146 to $500 and something, just so that people understand this isn't like a $20 surcharge. So it can be a big deal, right?
It can. In fact, I'm trying to think this year, I don't know if I have it written down somewhere, but it can go up to upwards of $500 a month from the standard one. And it's a graduated scale. The other thing is it's not like taxes and Social Security benefits, which is it's not a cliff situation, but IRMAA is. So the moment that you go $1 over into the next premium band, you're paying it for the 12 months. So you really have to work with someone and advisors who understand, because I tell you what, I know you and I both do it, Brad. We're like 63, that 63rd year. If you're planning on enrolling in Medicare at 65, you need to start thinking about the planning strategies that you're using. Because the other thing we're always trying to do is mitigate taxes in retirement, right? So what's the one way or a good way to do that? Roth conversions is a very good planning strategy, particularly while I say taxes are on sale through the end of 2025, right? They're going to sunset back up to the pre-2017 Act's tax rate. So people are doing these strategies that in the long run are really good for helping mitigate the risk of tax erosion on retirement income, but you have to be mindful of, is this going to affect my IRMAA premium? my Medicare premium through IRMAA? Is she going to come visit me? Is it worth it? Some people might say, well, I'm going to go ahead and take IRMAA in for a year and pay the piper just so that I can do that type of planning to get me into a better place down the road in retirement, so you have to just look at these strategies. And even Social Security claiming, even Medicare premiums, it's all so holistic. You can't look at anything without looking at the other thing, right? So that's why we do, and that's why we have a passion for what we do. It's like we all have to come together and say, okay, what do we really need to look at? It isn't, I should file for Social Security at X date. You can't do that without looking at everything else that's going on, right?
Very, very good. And I know we kind of went long in this segment, and there's because this is such an important topic. Just missing one thing or not knowing one thing can really impact your taxes and your premiums for the future. So make sure that you're working with a retirement income certified professional who knows all aspects of retirement planning. That's what we do here at Safe Money Radio. Hunter and I are both RICPs. Heather is an RICP. So if you want someone to give you a free financial consultation and take a look at your specific situation, just call us anytime and request a free financial consultation. You can call us at 866-780-SAFE. That's 866-780-7233. I'll even give you a copy of my book, Bulletproof, The Safe and Secure Retirement Income Plan. And the foreword for that book was written by America's IRA expert, Ed Slott. So call us anytime at 866-780-7233. There's someone standing by right now to take your call. Now, friends, if you're joining us today, we have Heather Schreiber with us, a national Social Security expert. And Heather, I want to ask you a question because I know this last year and this year, 2023, there's been a lot of talk about what everyone's calling the Great Resignation. I know personally, I've never seen so many 55-year-olds, 55 to 60-year-olds retire. They're just like, I'm done, I'm out, I'm over with. And a lot of them have pensions, but a lot of them don't. They're just tired of working. And so that's going to bring up the age-old question, whether or not they have pensions, whether or not they can withdraw from their retirement accounts before 59 and a half without penalty. And it depends on what kind of job they had, who they worked for, right? But it brings up the really big question that falls into a realm you deal with a lot, and that's Social Security. So what key things should a couple consider when they're thinking about when they should trigger their Social Security payments? I know that's a loaded question. It depends on a lot of factors, but what kind of things should they consider before they trigger their Social Security?
Well, I would say, generally speaking, when people retire, they look at retirement and Social Security claiming sort of as one and the same. Now, obviously, the 55-year-old can't file for Social Security right away, but for most people, they'll say, hey, and it makes logical sense. I'm going to retire and I'm going to replace that income with sort of my floor of income, which for most is Social Security. Yeah. But that you have to be careful about that. And the reason I say that is because that is one of the few sources that, for those that don't have pensions, and a lot of people don't, that's one of the few sources of income that's going to last for as long as you live. So making that decision in lieu of everything else, we have to obviously look at the health, how healthy is the individual and the couple. Is there a disparity in the income benefits of couples? You talk about couples, you have to look at that claiming decision, in respect to the couple. Because if I'm working with, if you present to me a client or a prospect that has, Social Security benefits, and there is a marked disparity in the income benefits, which we do tend to see still fairly often.
Sure.
What do we need to be concerned about? Even if the higher earning spouse says, I have poor health, it makes sense for me to file early. How can that be problematic later on? Well, because that higher earning spouse, when they file, as I've always said, is the gift that keeps on giving or not. Because if I have a spouse that is a much lower earning spouse, then if my higher earning spouse does in fact pass away early, if I were looking at that person singly, I'd say that probably made sense to do it, right? Because they're only going to be getting benefits for as long as they live. But if that person is married to someone who is going to be dependent upon what my higher earning spouse did in terms of claiming, what happens when one spouse dies? One of those two benefits goes away. It's the lower earning one. So if my unhealthy higher earning spouse filed at 62 or 63 or whatever the case may be, then as that lower earning spouse, I'm going to step up to that higher benefit when they pass, but it's going to be far less than if that person had said, wait a minute, let me look at how I'm going to file in lieu of both lives, right? Because I might have a spouse that's very healthy and he or she may be living into their 80s, 90s, gosh, maybe even 100. So I say, be careful about that of thinking as soon as I retire, I should file. You have to really look. Certainly you want to look at health, but you want to look at health of both. You want to look at their benefit amounts. How dependent is the lower earning spouse going to be on the survivor income of that claiming age of that higher earning spouse? Very important. And a lot of folks don't really understand exactly what happens when one spouse dies. So we need to make sure that we're looking at the longevity of the couple for sure.
Heather, as you know, you've probably heard everything under the sun, and especially doing a lot of public presentations, and you hear what people coffee shop talk about, what they think they're going to get or keep when someone dies. I've heard it all because someone said something at a coffee table or in a church life group or whatever, and I'll say, no, that's not it at all. You lose the lower income amount. And when you've walked through that either as a married person who's lost a spouse, or like I just did with my mother. My father passed away in August of 2022. My mother's income from Social Security was almost $900 a month. No way you slice that. That's a $900 a month loss of income from your budget. And so to use some real numbers just quickly, let's say one spouse is $2,500 and one's $900. You're going to lose that $900. But here's where it can really impact you. What if they were both income earners their entire life and one was $2,000 and one was $1,800? You're losing $1,800 a month from your income. And that's why it's such an important thing before you trigger your income to know your whole overall package. Because if you don't understand that in the future, hey, we might be losing $1,500, $1,800, $2,000 a month from our income, there better be something there to replace it, an annuity or some type of savings vehicle or a life insurance policy. Because if not, that couple, that family is going to get into financial trouble. We watch it happen all the time.
Well, and exactly. And the thing is, if you do have one spouse that is less healthy than the other and they do die early, they say they die in their early 70s or whatever the case may be, that's that much longer that surviving spouse has to have sustainable income. You've said, like using that example, they lose $1,800 a month, but then it's that much longer that they're stepping into that one income, and they need to be talking about how do we replace that income? Because if they don't have a pension, and even those that do are lucky enough to have pensions, generally speaking, it's a joint and survivor 50%. So again, we're losing 50% even in that income source. So that's why it's so critically important to say, okay, let's stop for a moment. We're going to retire. Where are we going to replace this income, and how should we strategically replace it so that we're maximizing? It's not how much you save, it's how much you keep, right? So we need to figure out how to build that income and guarantee that income for as long as the last of the two spouses lives.
Absolutely. And I know there's some of you are listening, some of you are watching. We'll just do a quick close up here. If we'll get my camera to focus on it for a minute, there we go. So there's Heather's Social Security Advisor newsletter. And if you want to learn more about what she does and having the answers to all kinds of things like this, I know she deals with a lot of questions and answers in the newsletter. So Heather, correct me if I'm wrong, but they can go to www.irahelp.com and they can click on newsletters and subscribe there to your monthly Social Security net newsletter. Is that correct? That's correct. That's Ed's website. They can go to Ed's website and download either of our newsletters or both, or they can go to my website, either one. But that's what's great about it is I talk to so many people on a daily basis. So that's where the content comes from. There's so much information to cover. And what's your website address, Heather? It's HLSretirementconsulting.com. Very, very good. If you're listening right now and you want to learn more information about Social Security planning, income planning, or maybe something we just said really caught your attention when you thought, yeah, there's a whole lot more to planning than just deciding to trigger at 62 because you can. You need to be thinking about replacement income and making sure that you're working with a qualified financial professional. Here at our office, both Hunter and I are retirement income certified professionals through the American College of Financial Services, and this is something that we specialize in. You can call us anytime at 866-780-SAFE. That's 866-780-7233, and just ask for a free financial consultation. Stick with us because after the break, we're going to be back with Heather with more questions. 866-780-7233. Someone standing by right now to take your call. Now, Heather, before the break, we were talking about specifically the age-old question of when should I trigger Social Security and all the different things that come into play regarding that, and it's a lot. I want to piggyback on that. I'm going to have to read this one. I wrote the notes down. I wish I had it all memorized, but I don't. So, on average, a 60-year-old male today should expect to live for 22 more years, and a 60-year-old female should expect to live 25 more years. I learned that from you. So, a lot of people try to figure out what's the break-even point? They try to do this math science thing. When should I trigger based on what my break-even point is if I live to a certain age? So is this the best way to approach trying to set up your lifetime income plan, or is there a better way? What do you think? You know, it's a good place to start. And naturally, it makes sense that people would say, hey, how long do I have to wait, or how long do I have to live exactly for it to make sense for me to forego income when I could take Social Security at 62? I mean, if my full retirement age is 67 because I was born in 1960 or later, and that's 5 years of income that I'm foregoing. So how long exactly? Right. That makes perfect sense. And certainly when you're dealing with a single person, I'm a lot more comfortable having that as our starting point. But here's the thing, is that Social Security, the calculation of the benefits. So whether you take it at 62, whether you collect it at 67, or whether you wait beyond 66, whatever your full retirement age is, or whether you wait to as late as age 70, the theory behind that, when the calculation of reductions for taking it early versus the delayed retirement credit increases for taking it even a few months beyond full retirement age, was that the Social Security said you're going to get basically the same amount of income because we've mathematically calculated the reductions and the increases based upon the average life expectancy. Right. What's the problem with that? What are we seeing these days? Yeah. Everyone is living longer and longer. And when those calculations were done, those reduction factors or those increases, it's based upon life expectancy tables that haven't been updated for the fact that people are living longer. So that's part of the issue. So people always say, well, what is the break even? Well, I mean, really,
to make it more beneficial from a mathematically cumulative lifetime standpoint of benefits, you only have to live to about 78 or longer for it to make more sense for you not to file at 62. I mean, I don't say, and I always say everyone's situation is so unique that I would never say never file at 62, nor would I say everyone should file at 70. If everyone could wait to file at 70, great, but that's not the reality. Okay. So I would say, most people, if they can, probably shouldn't file as early as they can because we're all living longer, right? So if we're living into our 80s and if we're living even to 82, 83, it actually makes more sense to wait because that is a guaranteed source of income that will last for your lifetime. So the longer you live, the more you're having to deplete other sources of income to supplement, right? To supplement the Social Security that you might have decided to take early. So I can go on forever, but for break even. So break even is a good place to start, but I wouldn't stop there. And particularly if you're dealing with a married couple, you have to look at the lifetime of both of them and the sustainability of income for the last spouse to die. And a lot of people fall short of doing that. They're not thinking about it that way because there's still a very significant chance that one of the two is going to be alive in their 90s. There's a 25% or more chance that one of them is going to be alive in their 90s. And so turning that Social Security on button at 62 may not be beneficial to the sustainability of everything else that then has to supplement the retirement income for as long as they both live.
And this is why I think this is important. There's so much bad information out there, that information that's not true. Just quickly, Heather, share with our listener why it's important to defer. Like the average person may think, oh, well, it's just me choosing to wait longer to get closer to my full retirement age. But what happens to the benefit of someone each year that they defer their Social Security?
Yeah, so the percentage is different between, 62 to your full retirement age. The reduction factors are different. But, if you have a full retirement age, if you're someone born in 1960 or later and your full retirement age is 67, you're getting a full 30% reduction for filing at 62. Now, the theory is you're getting 5 more years of income, but it becomes, the gamble isn't on your side the longer you live because you're, of course, taking that 30% permanent reduction. Now, I say permanent. There's always an exception to every rule if someone withdraws their application and pays back benefits within 12 months and they can start over and say, oh, I wish I hadn't done that. They can do that once. But for the most part, there is an actual reduction based upon the number of months you file early. On the flip side, once you get beyond your full retirement age, then there is what's called a delayed retirement credit. That is a monthly credit to the tune of 2/3%. You've heard this 8% per year. That's where that comes from. So 8% builds for waiting beyond full retirement age to file. That can be pretty significant. And the other thing is, once you file for your benefit, your cost of living adjustment, right, is going to be based upon that number. So if you file early, your cost of living adjustment, we just got the 8.7% cost of living adjustment that started in benefit payments in January. If you're taking your benefit at 62, that 8.7% increase is going to be less for you than someone who might wait a little bit longer and get, if they wait till full retirement age and get 100% of their primary insurance amount, so that the 8.7% is obviously based on a higher percentage. So you have to kind of look at everything together and figure out what makes most sense. Look at what other sources of income that the person has and say, okay, might it make sense for me to draw down an IRA and let my Social Security wait a little bit longer.
Keep rolling up. That's right. Yeah. Friends, everything that you've heard is so good. And I know at a recent meeting that we were at together, Ed said the average spouse lives 14.2 years after the death of the first spouse. So your decision for when you take Social Security affects that remaining income benefit for many, many years, often up to 2 decades. So we got to be thinking about the entire package whenever we make our decisions to file for Social Security. If you're listening right now and you want more information regarding when and how to file for Social Security or any type of retirement income planning, just give us a call. We do not charge fees to meet with our clients. Call and ask for a free financial consultation or a copy of my book, Bulletproof, The Safe and Secure Retirement Income Plan. You can call us anytime at 866-780-SAFE. That's 866-780-7233. And we'll be right back after this break to talk more with Heather. So Heather, I want to ask one more question, and then we'll wrap things up here in our next segment. But I want to ask you this. For anyone who is about to retire, if they've hit age 60, I ask our clients all the time, we've got about 1,500 clients, when do you start getting flyers in the mail? And they're like, oh my goodness, I'm already getting them. And it's overwhelming. And it's come to dinner, steak dinner, go, watch this webinar, you name it, what the Social Security training event at our facility. Everyone's an expert. Everyone knows answers that no one else knows. And it's never going to stop, right? When and it's going to be Medicare and Social Security planning and income planning and all of it. What advice would you give to someone regarding all this information that's coming in about how to be careful when it comes to choosing who you talk to about your financial planning?
Yeah, and I get them too. I mean, I'm not 60 yet, but I still get I always open them. I'm curious, That's right. And let's face it, everybody wants to know about Social Security. It's such a critical income source. So I would say, let your gut be your guide. I mean, I say anybody who is touting fear. So, you should, fear tactics I don't like, it's going to be gone, that kind of fear mongering I don't like.
Yeah.
And also you don't want any money that makes sweeping generalizations about what to do with any aspect, but certainly not Social Security. Everybody should just do this. Because to me that says the advisor isn't, concerned about looking at you as an individual or as a couple, because it is so incredibly important that this decision not be made in a bubble. I always say that. So, I always say, let your gut be your guide. When you're talking, if you go to these seminars or events or whatever, certainly get as much as you can out of it. But I don't like sweeping generalizations, and I will never give one. Everyone always asks me, when should people file? I will not tell you everyone should do X, because it is so unique to everyone's situations, when they plan to retire, what their income need is, what other sources of income they have saved or earmarked for retirement. Do they have health challenges? What's their goals? Even legacy planning. If someone says to me, legacy, I want to leave something to my kid, that to me, that plays into the plan for Social Security. So I'd say, just trust your gut. The other thing is, I'm very passionate about the right information. There is so much misinformation about Social Security, which is why I have made it a mission to make sure that people understand it. Because, like I said earlier, Social Security representatives, they're not there to guide you. They're there to answer yes or no questions and take your application, whether that's online or going down to the office to do it. So you have to empower yourself. You have to recognize that you probably do need help with trying to put all of those pieces together. The other sources of income that you have that you're going to use to supplement your Social Security, that makes a difference, right? Because we haven't even talked, that could be a whole segment, taxes and Social Security benefits.
Absolutely.
And long-term care, all of these things go into making a decision on when to claim, how to claim, that is very unique to each person that sits in front of somebody.
Well, I'm about out of time, and I would like to thank you for listening to Safe Money Radio. If you're serious about your financial future, give me a call, and together we'll get your retirement savings on the fast track to accumulation while reducing exposure to market losses. Thanks for listening, and until next time at the same time, I'm Brad Pistole, reminding you to stay safe so you can step into a secure future.
Safe Money Radio, your money saving sound.
You've been listening to Safe Money Radio with your host, Brad Pistole. Find out how to contractually guarantee that your hard-earned money is safe while avoiding market loss so you can have the retirement that you deserve. Call Brad Pistole now for your complimentary Safe Money book and Safe Money information kit at 866-780-SAFE. That's 866-780-7233.
Safe Money Radio, your money saving sound.
The preceding information does not represent tax, legal, or investment advice. Surrender charges apply to base contracts. Optional lifetime income benefit riders are used to calculate lifetime payments only and are not available for cash surrender or in a death benefit unless specified in the annuity contract. Fees may apply. Guarantees are based on the financial strength and claims-paying ability of the insurance company. No information presented today should be acted upon without meeting with a qualified and licensed professional. Obviously, by calling us now, you are just taking the first step towards protecting your retirement. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Rates and returns mentioned on this program are subject to change without notice.